Okay, I want you to picture a beast. And I don't mean some mythical creature. I mean something real. Something made of steel and concrete and high-pressure steam.
We're talking about the industrial giant.
Exactly. Imagine you are standing at the edge of a desert or maybe a huge industrial waterfront, and you're looking at a new refinery, a power plant. The scale is just, it's hard to wrap your head around if you haven't been there.
It really is. It creates a sense of awe. You've got miles of interconnecting piping, towers scraping the sky, flares burning off gas, and thousands of workers just moving around like ants.
But today, we are not talking about the engineering, not the welding or the chemical reactions or even the blueprints. We're talking about the lifeblood of that beast.
The money.
The money. And it's not just a stream money. On a project like this, it is a fire hose. You could be burning through $10, $20 million a month, maybe even more.
Oh, easily. And that creates this environment of potential chaos. If you don't have a leash on that cash flow, you're not just building a project, you're basically setting a pile of cash on fire.
And that is the ultimate nightmare scenario, right? So how do you prevent millions of dollars from just vanishing into a black hole? How do you know for a fact that you're building the thing and not just paying for it?
Because those are two very, very different things.
They really are.
And to answer that, we're doing something a little different today. We're actually going to decode a document that is, well, it's like the financial constitution for these mega projects.
It's a document with a really unassuming name. We're looking at SB 17 E3.3 cost control, specifically revision 01.
Cost control. It sounds so dry. It sounds like something you'd sleep through in an accounting class. But when you actually read this thing, it is aggressive.
It really is. This is technically an employer requirement. So this is the rule book that the person writing the check, the employer hands to the contractor. It basically says, if you want my millions, this is exactly how you'll account for every single penny.
It is the ultimate guide to accountability. It dictates how everything is tracked from, the massive process units all the way down to the plumbing in the site office.
So whether you're managing a corporate budget, maybe renovating your kitchen, or just curious how the big dogs keep the wheels on the bus, this is going to be a masterclass in transparency. We are talking about a standard they call audit ready.
Which is a standard that most people, and honestly most companies, just fail to meet.
Okay, so let's jump in. The document opens with this sort of mission statement in the introduction. It says the purpose is to demonstrate internal checks and sound control of all monetary transactions. Now, sound control. That feels like a vague corporate buzzword. What does it actually mean here?
It means the exact opposite of trust me. Sound control means you have a system that operates independently of the people running it. It means your invoicing isn't just a spreadsheet someone typed up on a Friday because they needed cash.
Right.
It has to interface with other departments.
Like who?
Like procurement, the people buying the steel, and material administration, the people counting the steel when it arrives on site. The numbers in finance have to match the physical reality.
So the accountant can't just be sitting in a dark room somewhere, making up numbers to make the quarter look good. They have to actually be talking to the guys in hard hats.
Precisely. And the tool they use to force that exact conversation is the first big concept we need to tackle. It's called the CBS.
The CBS. Okay, so Section 2 brings us to the cost breakdown structure. This feels like the backbone of the entire operation.
It absolutely is. Think of the CBS as the anatomy of the budget. Section 2.2 is very, very clear. It says, the contractor shall prepare a detailed cost breakdown structure based on key assets.
Okay, let me play devil's advocate for a second. If I hire a contractor to build a $1 billion refinery, why can't I just say, here's $1 billion, tell me when you're done? Why do I need to break it down into all these little pieces?
Because you can't manage a lump sum. $1 billion is just an abstraction. It's too big to even comprehend. You can't track progress against one giant number. You have to break the money down into buckets that match the physical reality of the site.
And this document is really strict about what those buckets are. I'm looking at Section 2.4. It lists the key assets they have to track. And it's not just labor and materials, which is what I'm used to seeing on, like, my car repair bill.
No, those are accounting terms. These are physical terms.
Right. The list is incredibly specific. It's got site infrastructure, power units, utility units, process units, cooling units, storage and loading units, buildings, and interconnecting units.
And the logic there is crucial. Let's say you just had one big bucket called construction. You could spend 50% of your budget building the buildings, the offices, the warehouses, the cafeteria, the easy stuff.
But you haven't even touched the process units.
Which are the complex, expensive reactors where the actual work happens, the hard part.
Ah, I see.
So if you just look at a generic construction budget, you look like a hero. Hey, boss, we spent half the money and the site looks busy. But in reality, you're doomed. You've spent half the cash on the cheap stuff and you haven't even started the expensive stuff.
So by forcing the CBS to track process units separately from buildings, the employer can see, hey, why is the warehouse gold-plated? But we haven't bought the main reactor yet.
It links the financial ledger to the things you can actually go out and touch. It forces the money to mirror the physical world.
And it's not a static document, is it? It says this CBS has to be part of the Project Execution Plan, the PPP, and it has to be corrected for variations and issued with every single progress report.
So it breathes. It's a living document. As the project changes, the breakdown changes. You don't just set it and forget it.
But there is one sentence in Section 2.4 that I think is the most terrifying requirement for any contractor reading this. I highlighted it.
I think I know which one you mean.
It's short, but man, it carries a lot of weight. Underlying figures shall be audit ready.
Audit ready? That is the phrase that keeps project managers up at night.
That sounds intense.
Yeah.
On a messy construction site, with mud and rain and thousands of invoices,
Yeah.
what does that actually require from you?
It means you cannot just present a summary table to the boss. It means imagine the employer points to a number on your report. Let's say $50,000 for site infrastructure this month. And they ask, prove it.
And you can't say, let me get back to you on that.
No. You need to be able, right then and there, to pull up the timesheets for the guys digging the trenches, the purchase orders for the gravel, the invoices for the rental excavators. You have to trace that $50,000 all the way back to the source documents. Instantly.
So no trust me, bro, accounting.
Absolutely not. And that creates a massive administrative burden. You can't do this with a shoebox full of receipts or some messy Dropbox folder.
And that explains Section 2.2, Item 5.
Right, which says the contractor's organization must include experienced and qualified cost control personnel.
Yeah, this is not a job for the summer intern. You can't just grab the CEO's nephew and say, hey, keep track of the receipts.
It establishes that cost control is a real profession. You need pros who know how to keep a set of books that can withstand a forensic audit every 30 days. Because if you fail that audit, the money stops.
Okay, so we've got the buckets, the CBS. We know where the money is supposed to go. But now we get to the tricky part, the part where projects so often go off the rails. How do we know if we're actually getting what we're paying for?
And that brings us to Section 3, Earned Value Status Reporting.
I've heard this term thrown around, but it usually just confuses people. What is the core problem that earned value is trying to solve?
It solves what I call the checkbook illusion. If I pay you half the budget, my checkbook says we're 50% done. But that's almost never true. You might be inefficient, you might have wasted money. Or, on the flip side, you might have bought all the materials, spent the cash, but haven't installed a single bolt yet.
So spending money is not the same thing as making progress.
Never. Section 3.1 defines the purpose really well. To show the contract value of the works executed. To enable the employer to register the correct values of the work in progress.
Earned value. I actually love that phrasing. You haven't just spent the money. You have to prove you've earned the recognition for that progress.
Exactly. And to visualize this, the document mandates something called the cost curve in Section 3.4. This is the truth serum of the project.
The truth serum. Okay, let's break this down. The document says this chart needs to track 3 specific lines all at the same time. I really want to walk through these because the interplay between them tells a whole story.
Sure. Let's visualize a graph. You've got time on the bottom, money going up the side.
Okay, got it.
First, you have the planned earned value. This is your baseline, your plan. Before you started digging, you sat down and said, by January 31st, I will have built the foundation and erected the first tower. That work has a dollar value. That's the plan.
Okay, so that's the promise. Line 1 is the promise. What's line 2?
The second line is actual cost. This is pretty simple. It's the actual expenditures at measured points. It's the cash leaving your bank account.
Okay, so line 2 is the burn, the cash going out the door. And the third line?
The third is actual earned value. This is the magic number. This represents the physical work you have actually completed, but expressed in dollars.
So let me get this straight. If I promised to build the foundation, that's line 1, and I spent the money to build the foundation, that's line 2, but I only poured half the concrete.
Then your actual earned value, line 3, is only 50% of what you promised.
And when you plot those 3 lines on one graph, You can't hide.
You can't hide. Let's just run a scenario. Imagine your actual cost line is way higher than your actual earned value line. What does that tell you?
It means I've spent a ton of money.
Yeah.
My actual cost is high, but the value line is low. So I'm over budget.
You are bleeding cash. You're inefficient. You're spending $1 to get 50 cents worth of work. Now let's flip it. What if your actual earned value is lower than your planned earned value?
That means my value is lower than my promise, so I'm behind schedule.
Precisely. By forcing the contractor to put these 3 curves on one chart every month, the employer can instantly see the health of the project. You can't hide behind vague claims like, oh, we're making great progress. The curves tell the truth.
And Section 3.2 also says the contractor has to show methodology used for calculation of earned value. Why is that little detail in there?
Because without an agreed-upon methodology, contractors love to guess. They'll look at a half-built wall and say, looks about 80% done to me.
When it's actually 40%.
Right. This document requires them to show the math. If you say the power units are 40% complete, is that based on concrete poured, steel erected, man-hours spent? You have to define the ruler before you can measure the work.
It stops them from grading their own homework.
Exactly. Now, there's another layer to this cost curve in Section 3.4. It says the curve also has to show agreed variations and the value pending variation proposals and claims.
Variations and claims. This is where the fighting starts, isn't it?
Always. A project is never static. The employer changes their mind. That's a variation. Or the contractor hits a bunch of rock they didn't expect to. That's a claim.
And usually contractors like to keep those claims in their back pocket for later.
The old lowball and ambush. You bid low to win the job, you save up all your claims, and then a month before the project ends, you slam the employer with a mountain of extra costs.
Surprise, the project actually cost 20% more than we said.
Exactly. This document is designed to kill that strategy. Section 4, reporting on variations and claims, requires the contractor to show the actual state of these claims on a regular basis.
Even the pending ones.
Especially the pending ones. The document says the cost curve must visualize pending variation proposals. If you think you're owed money, you have to put it on the graph now. You can't hide it in a drawer.
So it just creates total visibility. If there's some massive claim sitting out there that could blow up the budget, the employer wants to see that red flag waving on the monthly report.
It forces the reality of the situation out into the sunlight. You might fight about the claim later, but you can't surprise me with the existence of it.
Visibility is control.
That is the mantra of this whole document.
Okay, so we've broken down the budget with the CBS, we've measured progress with earned value, and we've exposed the hidden costs with variations. Now we get to the part everyone actually cares about. The transaction. The invoice.
Section 5, reporting on invoicing. This is where the rubber meets the road.
You'd think an invoice is simple. I did X, pay me Y. But Section 5.3 requires an invoice register with every report, and the requirements in Section 5.4 are, well, they're exhaustive.
They really are. The list runs from item A all the way to M. They want to know everything.
Let's pick a few of these apart because I think they reveal what the employer is paranoid about. Item D is invoice type.
Right. They want to know, is this a progress payment, a milestone payment? Is it for a variation?
Why does that distinction matter? I mean, money is money, right?
Not in accounting. You have to categorize why you're asking for the money. If you try to sneak a variation cost, an extra charge into your regular monthly progress bill, that messes up all the tracking. This rule forces you to label the bucket before you ask for the cash.
Keeps the data clean.
Okay.
Then there's item, accounting code, and it gives this specific example. SAP PO number, line item number.
This is the corporate link. SAP is this massive enterprise software that global companies use. It's the brain of the corporation.
So this is connecting the field to headquarters.
Exactly. Construction sites are messy. They're full of mud and paper receipts. But headquarters runs on digital codes. By demanding the SATO number on the invoice register, the employer is tying the muddy boots on the ground directly to the clean corporate ledger at HQ.
It prevents a situation where the project manager is approving invoices that the finance department has no idea about. It forces the two worlds to speak the same language.
It ensures those internal checks we talked about right at the beginning are actually happening.
Okay, but here's the one that really stood out to me. It almost made me laugh. Item. Days overdue.
Ah, yes. That is a fascinating inclusion, isn't it?
So let me get this straight. The contractor, the person asking for money, is required to report on how slow the employer is at paying them.
It's a form of reverse auditing. The contractor has to track the planned payment date, that's item J, versus the actual payment date, item K, and then calculate the days overdue.
That feels incredibly bold. Why would the employer require the contractor to call them out and say, hey, you're late paying us?
Because on a project this size, cash flow is oxygen. If the employer's own finance department is slow or an invoice gets lost in an email chain, the contractor runs out of cash.
And if they run out of cash, they can't pay their workers.
And if they can't pay the workers walk off the site. The work stops. The project manager on the employer's side, the person responsible for the schedule, wants to know if his own finance team is dragging their feet.
That is brilliant. It turns the invoice register into a performance review for the employer's own accounts payable department.
It makes sure the machine is checking itself. It goes right back to the purpose in section 5.1, to show the actual state of submitted statements, invoices, and actual payments. The actual state includes the ugly truth that sometimes payments are late.
So when you step back and look at this whole document, from the specific buckets of the CBS to the 3 lines on the cost curve down to the SAP codes on the invoices, what's the big picture story here?
The story is that on a project of this size, money is not just currency, money is data.
That's a powerful idea. Money as data.
Well, think about it. A dollar bill here isn't just a means of exchange, it's a tracker. It tells you what's been built. It tells you how efficiently it was built. It tells you how the plan has changed, and it tells you how the cash is actually moving through the system.
It creates a shared reality.
Exactly. Without these rules, the contractor has one reality, which is usually, we're working hard and we need more money, and the employer has another, which is, you're spending too much and moving too slow.
And usually those two realities don't meet until they're screaming at each other in a courtroom.
Precisely. This document forces them to look at the same audit-ready figures every single month. It removes the ambiguity.
And that phrase, audit ready, really sticks with me. It is such a high bar.
It's the only bar that matters when you're dealing with hundreds of millions of dollars. If you aren't audit ready, you aren't in control.
You know, as we've been talking, I keep thinking about how this applies outside of just heavy industry. We started this deep dive thinking about refineries and power plants, but the principles here feel pretty universal.
Oh, they absolutely are. The scale changes, but the logic doesn't.
I mean, think about renovating a house. That's the classic nightmare for most people. You hire a contractor, they ask for a 50% deposit, and 3 months later, all you have is a demolished kitchen and no workers in sight.
If you applied SB 17 E3.3 to your kitchen renovation, that would not happen.
Right. If you demanded a cost breakdown structure separating plumbing from drywall from electrical, you know exactly where your budget was going. You wouldn't just write a check for kitchen.
And if you tracked earned value checking, if that 50% payment actually matched 50% of the physical work completed, you wouldn't get stuck paying for cabinets that haven't even been ordered yet.
It's just about accountability. Whether it's a billion-dollar mega project or a bathroom reno, the lesson's the same. Break it down, track the progress against the spend, and never, ever pay for work that hasn't been earned.
And always keep your receipts, or in this case, your invoice register.
And hey, maybe track those days overdue, too. Keep your spouse or your bank honest.
It keeps everyone honest. Visibility forces accountability.
So here's the question we want to leave you with today. We talked a lot about that cost curve, that visual comparison of what you plan to do versus what you actually achieved versus what it cost you.
The holy trinity of performance.
So if you had to plot your own life projects on a curve like that, maybe a career goal, a fitness plan, a creative project, and you compared the energy you plan to spend versus what you actually spent and what you actually achieved.
Would your personal cost curve be audit ready?
Or would you find some pending variations hidden in a drawer somewhere? Some excuses you haven't put on the chart yet?
That is a very uncomfortable question.
If you're interested in the templates, please visit our shop. The link is in the description.
Thanks for watching. Please subscribe and see next time.